let's begin. I'm going to turn the mic over now to Chris Carter. Oh, brief outline of the topics discussed tonight. Chris, if you might want to go through this in the beginning so you can let everybody know. And let's welcome Chris Carter as our first speaker. Thanks, everybody.
Thank you very much. Good evening, everybody. On behalf of Adrian and David and Doug, myself, we're very happy to be here. We appreciate the warm welcome. We especially want to thank Don and Marty, Stephanie, and members of DIG, and of course Giuseppe's for hosting us tonight. So thank you for having us. There was a slide up earlier which was the Big Bang / Big Bank graphic, and I thought how appropriate that is, because in my little dialogue here about market conditions and trends, basically the past really influences the future, right? Or in this case, the present. So we don't have to go back too far in our financial history. We're not going to explore metaphysics or biology or anything. But as far as finance goes, in 2008 we had the mortgage meltdown. That meltdown really precipitated in a massive amount of regulations that we've been subject to more or less ever since, right? We've had some ebb and flow to it. We've had some recent breaks in it, but by and large, those regulations are here to stay, and we have to figure out how do we navigate through all that? How do we deal with the present? So I just want to talk about some of the economic factors that we're in presently. So right now, we've entered into the 8th year of an economic recovery, and that economic recovery is basically characterized by the lowest annualized GDP growth since 1949. So all the expansions that have occurred ever since prior recessions, this is by far and away the slowest one, right? So we've had our hurdles here. While we're in the sweet spot of low inflation and historically low interest rates, it's a nice position to find ourselves in. We're also experiencing a 30-year low presently of residential home inventory, and I'm sure you guys have been experiencing that out there in the marketplace. The ratio right now locally for buyers to sellers, especially with homes priced under $500,000, is 3 to 1. Now that seems like a lot, and we're definitely seeing a lot of full price offers, over asking price offers. In that type of seller's market, we're not seeing as many concessions given, less seller assist. Maybe there's pressure on the buyers not to do certain inspections and things of that nature. So there's definitely been a shift in the dynamic from a buyer's market, which was only a few years ago, to the current market. And by the way, the purchase prices that seem to linger above $500,000, the further north you get from that number, the more it becomes a buyer's market all over again, right? So while that 3 to 1 ratio seems somewhat impressive, there are markets throughout the country that basically dwarf that. And for instance, as close as, let's say, DC, as far away as, let's say, Colorado, the ratio balloons to 10 to 1. So you can imagine if you have 10 buyers for every home for sale, what does that do to the market? What does it do to prices? What does it do to the property values and things like that? So it's definitely a big challenge, and we're seeing sealed bids again. We're seeing some telltale signs potentially of another, it's a boom market, but we also, on the residential finance side, we always worry about, are we going to be able to sustain this level of growth, right? So the Federal Reserve has raised rates 5 times over the last 3 years. I'm sure you guys have seen that. And there's an 80% chance, they just announced last week, that they'll probably have another hike between now and year end. Over the next 2 years, they're anticipating as many as 6 more hikes. So now we're going to start to see some interest rate pressure that we haven't had to this point. Right now, the home ownership rate in the United States is 63.5%. That represents a multi-decade low. Basically, it hasn't been this low in over 2 decades. And does anybody have any millennials at home? No? Some, get them out of the house. We want them in the market. They need to be out there buying, okay? First-time home buyers basically make up 40% of the residential real estate market. So, and not to pick on millennials, but basically what we've seen, that paradigm shift is, young people are staying home longer, right, with their parents or families. As a result, they're getting married later, they're having kids later. So the real estate market is a recipient of that later part. So what we're seeing is we're finally getting to that, point at which it's tipping over and the millennials are starting to hit the real estate market. But what are the challenges for them? Well, there are many. Living at home. Their student loan debts might have just kicked in, so that presents a problem. Maybe they don't have an amount of credit like that would constitute a history. So, this is a market that we really need to nurture. And how do we do that? We come up with certain products like, first-time home buyer programs and low down payment programs and things like that. Where we're concerned tonight, what we want to kind of discuss is what kind of products in that similar vein, that similar channel, what can we do to basically navigate through the current market if you're a real estate investor? So my colleagues up here are going to speak to that in a couple minutes. Fannie Mae, Freddie Mac, the Mortgage Bankers Association, and the National Association of Realtors, one thing they all agree on is that the projections for next year, year over year, are going to be better than they were in 2017, which was, by the way, better than 2016 and 2015. So we've seen let's say, a good steady growth in the real estate market. Some areas like the construction market are still lagging behind, but by and large, the resales are definitely forging forward. The availability of credit is still a hurdle. We know that. And I talked about the supply and demand factor that's resulted in a spike of prices and in property values year over year since 2014. So we've had these tremendous headwinds since the Great Recession, and this massive regulation I alluded to has resulted. So the pendulum, naturally, whether you're a government agency or an economy, always tends to swing pretty wildly and dramatically from one side to the other. So to that point, prior to the collapse, the mortgage and banking industries had basically 14 regulatory agencies that we were subjected to. They all simultaneously failed, right? The government's response to this was not to fix what was broken, but to create, in essence, basically a 15th agency, right? So the 15th agency is the Consumer Finance Protection Bureau, and they oversee these other 14 agencies, and they're charged with meting out penalties and fines and things like that. Whether we think it's constitutional or not, whether we like these regulations and the extremes that they've gone and the penalties we've had to pay on the financial side, I will say it's been effective. I will say that the only paper that seems to exist in the financial markets today is true A paper. So not the big short type of A paper, AAA rated paper, but actual physical real A paper. So most of us in this room are familiar with Dodd-Frank and TRID. These series of guidelines and regs apply to every lending institution. So while we'll touch on some of the maybe unique products that Univest has, we're going to speak in generalities, and some disclaimers, not to be weird, but it depends, it depends, it depends. That's what's going to happen. There's no magic bullet for financing. I'm sorry if you came here for that. It's not, I don't have one. But we can help you as far as, with the support and some of the information we'll be able to offer you tonight. I used to ask people at time of application, who you are, where you live, where you work, what do you make? And those questions, they're all the same, but lately I've been asking, what's your blood type and things like that. I mean, it has gotten very extreme. There's no question about it. So I'm an optimist, may not sound like it. But after my wonderful Newt Rockney speech here, I'm going to turn this over to Adrian. He's going to talk about some of the, actually, you know what, before we do that, I'm sorry. We have some polling questions. This, again, very unscientific, show of hands, just so we know maybe how to proceed for you tonight. How many are you seeking as investors, let's say, residential opportunities in the market? Oh, okay, it's most of the room. How about commercial? All right, so how about both? Who's here for a free dinner? Okay. All right. On the residential side, how many folks are seeking, let's say, like a single-family dwelling, like a one unit? Okay. And how many for, let's say, multiple units? They say 1 to 4. Okay. And then how about like apartment complexes, like multi-unit? Okay. Fewer hands, but there's still some. How about mixed-use properties for anybody? Like a combination of commercial, residential? Okay. We do those as well. I'm going to switch to price ranges. How about like under $250,000 as far as your target price? Okay. Between $250,000 and $500,000. Okay. And then over $500,000. Okay. Then that's consistent with the mixed use and the commercial and all that. So multifamily. Everybody in the room, as far as like buying and holding the real estate and having a tenant in it, how many people are looking to do that? Okay. And then how many on the other side are looking to do flipping, like actually renovation and things like that? Okay. And maybe a mixture of both for some of you. All right, so that will definitely help us. Thank you for your participation in that. I'm going to turn this over to Adrian right now. Here we go. Thank you, sir. You want the mic?
Sure. Well, thank you, Don, everybody, for having us dig. Chris, I think Chris stole my thunder here. That's more than 5 minutes. But anyway, so I've been in the business for about 20 years. Just a little quick introduction. I'm the Vice President of Underwriting and also Credit Policy. So most people in this room probably don't like underwriters. But, for a right price, we'll get it done for you guys. But anyway, anybody here, we got a tough crowd here, man. And I promise these guys are going to keep it to a minimum. Anybody here that actually worked for a banker or a mortgage company or had experience? Okay, great. Awesome. Which company? If you don't mind me asking. Great. That's okay. But so anyway, so basically, I'm not going to bore you guys with all the logistics. What I'm going to do is kind of give you kind of overview of what we do, why pick Univest, right? And kind of going to save some questions to the end. I'm more of a Q&A kind of guy when I do meetings. I'm sure, I don't know, show of hands, I guess most of you guys like that format, I'm assuming, right? Instead of listening to a guy kind of speak forever. But anyway, so a couple things here. As we all know, the agencies made some changes. Chris talked about CFPB. Obviously, there's a lot more transparency in the regulatory side. However, God bless you. So on the residential and commercial side, so we do both, Univest, and we do a lot of referrals between commercial lending as well as residential lending, and things that we can't do on a commercial side, we might be able to do on a residential side, and vice versa. Now, Univest, what kind of sets it, I guess, a little bit apart from everybody else is we hold loans for portfolio investment, and we also sell off. We sell direct to Fannie Mae and Freddie Mac. We also sell off to our government investors on the primary side. But we also, on the portfolio side, we do a lot of, investor type loans. Big thing is, now kind of show of hands, how many of you are looking to hold real estate individually versus as a partnership or LLC? Individual, okay. So obviously on a residential side, big difference between residential lending and commercial lending is obviously the borrower type, right? So for residential side, we're looking at individuals, right? Or we're looking at revocable trusts. Now, if you're going to hold it as a LLC, that'll be more, and Dave will talk about it, that'll be more on a commercial side. So based on some of the regulatory changes, it kind of restricted us on how we can hold certain loans. But we do, on a portfolio side, we do have a lot of options, right? Like we talked about mixed use. And on Univest side, where Fannie and Freddie are a little bit more restrictive, on the portfolio side, we could do a little bit more mixed use properties. I know I saw some show of hands here. People do mixed use. On the investor side, we'll make some exceptions. So those are kind of, products that we might be able to offer where other banks may not. I know we also do, and I know Doug will talk about this, we do a lot of renovation loans. We do second home renovation loans. I don't know how many of you out here are interested on that side. Anybody interested in those sides? Okay, all right. So that's quite a few here. But we will, so that's kind of where we're at as a investor. Fannie and Freddie, they did lighten up on the restrictions. I know like right now they'll go up to 10 finance properties if you're an investor. Univest, we will finance on the portfolio side 10 Univest finance properties up to $5 million. I mean, that's a kind of a pretty good exposure on our end. Before we had some limitations. I know some investors kind of shy away from the investment property transactions, where we actually still offer it. We also offer it on the second mortgage side. We'll do investment properties. We'll do renovation properties on the home equity side as well. So just to keep that in mind, so we kind of have a pretty good mix of product. As far as what kind of constitutes a residential mortgage versus a commercial mortgage, obviously it'll be property type, single family or multi-unit up to 4 units, and then obviously mixed use. We'll do a mixed use properties up to 25% mixed use, but we do have some more latitude on our portfolio side, where even we've done working farms. I know a lot of people don't do them in a residential side. We'll do if you have investments like a mixed use property investor, multi-unit with a salon, barbershop, what have you. Obviously, there's some restrictions, a little bit higher down payments requirements or asset requirements. However, we do have that offering. So that's kind of basic kind of overview of Univest, our credit policies. I'm going to turn it over to who's next here, Doug Schnell, who's actually our renovation expert. So I'm not sure, how many of you are into some of the other products. We do offer some 2 or 3K products and some other renovations on the primary side, but we also have a lot more on the investor side as well. So Doug?
Thanks, Adrian, and thanks, Chris. I'm not going to talk at all about CFPB. I'm not even sure what the heck that means, but I did like that. Adrian, that was awesome. I've got a question for everybody, and this is very important, very relative. I know we're all in Bucks County. How many of you are actually looking to invest in Bucks County versus maybe Philadelphia? Let's start with Bucks. And how about Montgomery County? And how about Philadelphia? I want to ask one more question. How about New Jersey? Thank goodness there aren't too many. We would have to get passports. That was a bad joke. But I'm here really to talk about how things have changed a little bit with documentation, with over the years, what we ask for on a mortgage, whether it's an investor or not an investor. Not a lot has changed, and we used to do what we call stated income, and you guys probably remember those loans. And we barely asked for anything. We ran a credit report, shook hands, and closed the deal. But times have changed so much, and we are asking, as Chris was talking about blood types and things like that, it's almost true. We ask for an abundance of material. Tax returns are nothing. I mean, we ask for everything, written explanations of things that come up on your credit report as far as your address history for the past 10 years. Inquiries. Why did you shop at Home Depot? That's a little suspicious to me. Lowe's maybe, but Home Depot? I mean, things like that, we really get into all that. So anytime you do apply for a loan today, whether you're with Univest or any big bank like a Wells Fargo, you're going to be asked for the same documentation no matter where you go. So, I see people coming from different banks, and the reason they came back to us, they thought, oh, community bank, they're going to be friendly. Well, where did you come from? Wells Fargo. Well, why did you leave them? Because they were asking me for tax returns. Well, don't you think they should know, maybe where you worked for the past couple of years and how much money you made? Since we're lending them, they're lending you the money, let's make sure you're qualified. So we're going to ask you for the same things as far as that goes. Times have tightened up and gotten a little more tough as far as getting the actual financing in place, but you want to start with the right experienced bank person that can at least guide you in the right way and get you to the right loan. Because there are a lot of different options out there. I do or I've done in the past, a lot of government loans in Philadelphia. And the nice thing about Philadelphia, I was talking to somebody earlier, I think Stephanie, right? I was asking Stephanie, where do you invest? And she stays out of Philadelphia. I personally think, and I shouldn't bring my personal business into this, but Philadelphia is a superb opportunity as far as investment, because there's so many people that come from outside this area that don't know Bucks County, but they certainly know Philadelphia, and people from New York and Washington, D.C. are coming to Philadelphia to invest, and they're used to much higher prices. So that's just one thing, but as an investor, is there a big difference between you guys versus, a millennial, for instance, who's buying their first house? And the answer is yes. There's a huge difference, because what are we expecting from an investor versus a first-time home buyer? Does anybody know that answer? I mean, absolutely, experience. But it's more than that. It's just very simply credit and money and assets in place. Because when you get into investing in single family, duplex, multiple families, the more you invest, the more you get financing on those properties, the more money you're going to need. So in other words, we need reserve money, so if you buy just one investment property, we may only need 3 to 6 months in reserves, which is your principal, interest, tax, and insurance payments. Where when you start getting into multiple units and you start getting to 6 and 10 and 12 units, you need an abundance of money, of capital to get into that. So where do you access money today? It's not going to be just getting a first mortgage or even a second mortgage. You start thinking about where do you come up with this money? And there's a lot of ways to get it. If the house, and I know I'm going off on a tangent, but if we were talking about LLCs versus individual names, if I was going to buy investment properties today, the first thing I'd want to do is make sure I had that money available. Make sure before I even go out and look, I'd want to know, exactly where the money is coming from. Am I getting it from the bank? Do I have to pull a line of credit from my primary house? Univest does offer cash out lines of credit for your investment properties. So if you have, multiple units, investment properties that you do own, and maybe you have, 50, 60% owner equity where they're paid off in full, you could come to us and get a line of credit on each of those properties to access money, up to a total of $500,000. So it doesn't seem like a lot, but if you can pull $500,000 to buy those next investments, it might be an easy and affordable way to do it, rather than refinancing a property, which would cost you maybe more money to do. My specialty in the past 17 years out of 28 has been doing renovation financing. And I think as an investor, the biggest difference on property type versus a first-time home buyer, I think first-time home buyers are generally afraid of buying a house that needs work. So I think, a lot of times I think as an investor, you're looking at what's next, because you don't want to pay full dollar for what's out there on a house that's already renovated. You want to get something that you're going to make some equity on. So renovation loans, we do offer a conventional product only on a single family, where you can actually buy the house and put money into it to renovate it on a single family only, up to 85%, which is based on future value. So if you buy a house for $100,000 and the house needs $50,000 in renovations, we'll finance off of that 150, 85% as an investor for a single family. We can do up to 4 of those, but again, they have to be single family homes. Anything else? Dave, I think I'm going to pass you on because I don't have much else to say tonight. Thank you.
Does anybody mind if I sit down for this?
Not at all.
So thank you, everyone. I'm going to talk about commercial loans and commercial financing because that's the area that I'm in. I work in the business banking division, and we do we have a focus on commercial real estate, investor real estate. It's a good part of what we do on a regular basis. You know, our typical request is either a purchase of a new place, or it's a cash out refi. To make it into my world, there's only two things that I worry about. One is you have an LLC or some kind of business entity that's purchasing that property, right? Could be an S corp, although that's really not that common in this world anyway. Most of them are LLCs, sometimes a partnership. The second thing is you could be buying it as Joe Smith, but if it's a commercial building, it's a commercial loan. So if that's a mixed-use property with 4 residential apartments upstairs, that's a commercial building. If it's zoned commercial, it's a commercial building. I'm working with an investor now who is purchasing a house that has a greenhouse out in back. So it's a commercial property. So it's either the property or the buyer that makes the loan fall into my world. It's kind of interesting because right now, for you guys anyway, if you're a buy and hold investor, we're at the highest level of renters to homeowners that we've been since the late 80s. So, and it seems to be, I think part of that's with the millennials, seems to be the way that people want to go. They want to be more mobile. They want to have less of that I don't know, commitment or that building. So renting is a big thing, not just single family, but also multifamily. In some cities like Washington, D.C. and North Jersey, that's, you know, area of Baltimore, it's going crazy with multifamily. For us, by the way, investing in Philadelphia, depending on where it is a very good proposition. There's some really hot neighborhoods in Philadelphia. We've churned through a few. Point Breeze is, you know, probably up at the higher parts of that right now. There's other parts that are, 2 years ago, you didn't want to go walking at night over there, and today you want to try to find a place for sale so that you can buy it and then sell it in 2 years or a year at a huge profit. So Philly can be a good place to invest on a commercial side, for sure. For us in a rising rate environment, well, before I even get to that, one of the things that happens when you move from that residential mortgage to a commercial mortgage is that term and amortization that you always think of. Hey, I got a 30-year loan. Nobody ever talks about anything other than that in residential. In commercial, there's the term and there's the amortization. They are two separate and distinct things, and typically the term is smaller than the amortization. In a rising rate environment like we're in right now, the length of time that a commercial lender wants to go is being pulled in. Year or so ago, 2 years ago, you could get a 7-year commercial mortgage fairly reasonably. Now, if they offer a 7-year at all, you're paying a bit of a premium over the typical 5-year. And by the way, 5 years is the typical term on, and has been forever on commercial properties. Why? Because a commercial property is just that. You're not living there. It's not your roof. And yeah, you got money tied up into it, but there's the risk that I'm going away, and whoever financed it is stuck with the property. It's a bigger risk, therefore, they're not willing to go out as far, especially since in a residential neighborhood, relatively speaking, prices are stable given a chunk of time, right? If you look at it this year, the residential price of a home in this neighborhood is pretty, lockstep. It's easy to establish. In the commercial world, you may pay $1.5 million for that commercial building today, and in 2 years, it could be worth $500 because of something that happened with the environment, with regulations, with zoning, with government, the economy, who knows? Maybe it's a single-purpose use commercial building, which case it's got to be, I guess the key is it depends in commercial much more so than in residential because every deal is unique. The property, the buyer, everything. So in any case, in that rising rate environment, the term is being pulled in, the rate is tending to go up. Right now, the fairly typical commercial mortgage is 5-year term with a 20-year amortization. Why is the amortization important? Well, if I've got to pay you for 5 years and I've got an investment property, I'm looking to what? Maximize my cash flow every month, right? If I can get a 25-year amortization, that means my monthly loan payment to Univest or Wells or whoever it might be is that much lower for that 5-year period. If it's a 20-year amort, the monthly payment's a little higher. We're only talking marginally smaller dollars, but it's still dollars that go in your pocket versus the bank's. But the conditions right now, 520 is the standard. You still can maybe find a 525, but they're getting harder and harder to come by. And if you can get a 525, you might be paying a higher rate. So there's a lot of moving pieces in that. What's the rate? What's the amortization? What are the fees? People I've found in real estate investment, people forget a lot about the fees. They look at the rate. What's your best rate? I can give you any rate you want. You want 2.5%? As long as you're willing to pay me the fees up front, I'll give you 2.5%. It doesn't matter. Not that banks typically do that, but it's just to make a point. It's all about what kind of money can the lender make out of a typical transaction. Do I make it now or do I make it over a period of 5, 10, 20 years? Doesn't, in the scheme of things, doesn't matter as much. In the commercial world, you're going to find a higher rate. There's fewer commercial mortgages, there's higher risk, and there's not the same sources of funds available for a commercial lender as you find in residential. So you'll see higher commercial rates. Rates are, they're running in the high 4s to low 6s, depending on the strength of the deal, strength of the borrower, all the different factors that go into commercial. One of the other differences between residential and the commercial world is we both ask for documentation, but in the commercial world, we're looking for things perhaps a little deeper. How many people in this room understand what a cap rate is? Okay, the same people that were asking about commercial mortgages. Interesting. Cap rate is a number that people look at more in commercial, but it basically what that tells you is if I've got 3 commercial properties in front of me, and I'm trying to decide which one of these I want to buy, cap rate's a good indicator. It's your net operating income by your sales price. And it tells you how many years it takes for you to recoup your investment, basically. And I'm simplifying, obviously. When I look at it, or when the commercial lender looks at an application for a commercial mortgage, there's one other number that's much more important. We don't really care about that cap rate. We do care about the net operating income. That's a real important number, but it's really that and cash flow. We want to see if you have the cash flow to pay the debt. It's the debt service coverage ratio. And every bank has a different one. I've seen, ours is 1.25 right now, but I've seen 1.35, 1.4. There's different numbers that banks use for that. They want to just make sure that out of your property, every month is, because you're paying the loan based on cash flow from it, that you have enough cash flow to make that mortgage payment and the other, of course, the other debts that you have. When you're dealing with multiple properties, we're also very much concerned about that rent roll and how that cash flow spreads out across those multiple properties. So I've seen cases where an investor comes to me with 10 or 12 properties, and 8 or 9 of them are cash flowing just fine. There's a couple there that are a little on the fence, and maybe 1 or 2 that are that are definitely below. That debt service coverage ratio is bad. Does that mean they're a bad borrower that we wouldn't want to lend to them? No, because we're going to look at the whole portfolio and come up with an average debt service coverage ratio for the portfolio to determine whether or not this new property is lendable or not. Of course, the specs on the new property have to be there too, obviously, but you might not see that as in that, I don't know, that kind of depth on your residential when you're dealing with multiples?
Yeah, residential is largely like it's a single transaction for us, right? So we're lending to the individual, not the entity. We're gonna, if you're an investor with tax returns that are yay thick, I mean, basically we're taking an average of that adjusted gross income. We'll do things like
Chris, could you get closer to the mic, please?
Oh, I'm so sorry.
You're not
I was getting
forgiven.
too relaxed. Sorry about that. So basically what I was saying, just to recap, on a residential transaction, it's largely individual. We're lending to the person, not the entity, as you would on commercial. Commercial is going to look at, cash flow. Potentially they can do some blanket financing, to an entity and things like that. On the residential side, again, we're lending to the person, not an LLC or such. And what we do as far as how we interpret those tax returns is we're going to take those, multiple recent years of filings. We're going to average out the adjusted gross income by and large, and then we'll add back things like depreciation, things like that. But we want to make sure that the, properties support themselves. As Doug touched on, one of the biggest challenges that I find is not just the initial investment. If you're a residential investor, it's having those cash reserves somewhere. They can be retirement reserves, by the way. They could be 401k. They could be IRA funds. They could be something other than, let's say, liquid, right? They can be, emergency funds. Typically, they can't be a gift. So basically, I think one of the challenges we find is not the initial equity position on a specific piece of property so much as it is if you're a rabid investor and you've got, multiple finance properties, it's supporting that I need 6 months reserves for each individual property, and that has to carry over, so into the total. So that's one of the more, significant hurdles. But as Adrian mentioned too, we did have that bump, I think it was like the end of July, where Fannie Mae had loosened some of these guidelines, in particular, like the number of multi-finance properties on the residential side. One of the things we do is obviously we write to Fannie and Freddie guidelines, but as Adrian mentioned, there's this distinction between portfolio, which are loans that we write that stay on the books, versus, let's say, those agency loans. And the primary distinction I'll say is, on the agency stuff, we're looking at your fixed rate vanilla type of financing, right? Your generic 30-year fixed, 20-year fixed, 15-year fixed term. So it's kind of flatlined all the way through, open-ended, fully amortized. On a portfolio transaction, we're talking about something that's more akin to like the commercial side, where it's a 3-year, 5-year, 7-year, 10-year arm. So you're fixed for, 3, 5, 7, or 10 years. It would turn into some type of 1-year adjustable thereafter on that anniversary date. And there are caps set in place as far as the rate can never rise above X. It can never fall below the floor at Y. And those transactions are typically, like I said, they're amortized over a 30-year term. A lot more let's say, liberal than, let's say, on the commercial side, where you're kind of, in that 20-year amortization. So I hope that's helpful.
So we also, on the commercial side, I know Doug mentioned I think Doug mentioned the line of credit. On the commercial side, we've been, stretching the boundaries of that a little bit as far as real estate investors go. So one of the big challenges we hear from people in the field is that, hey, I can get the money, whether it be hard money or from a company like Don and Marty's funding for flippers or other financial sources. I got the money to buy that flip, but now I got to come up with a budget for renovating. Where do I get that money from? And that sometimes is a little harder to get. Again, on the commercial side, we do have a qualification process. We're looking for a quote-unquote qualified investor, but we do have some product available where if you have a portfolio of buy and hold properties, we can do a cash out refi into a line of credit. That line of credit, and again, it's the facility is written pretty specifically, but it's written so that you can go out and buy a property with that line of credit. And again, there's some approval process to that, but everything's in order. We can buy that property. Then you can use that line of credit to do some renovation work to it. And at the end of that process, so you've got your money in for purchase, your money for renovation, and now you've got the property rent stabilized. You got some renters in there. You've got leases signed, and it's been chugging along for a little bit. Now we can take that line of credit out with a term loan and bring that line of credit back to zero so that now it's ready and loaded for that next purchase. So again, it's not available to every investor in every situation, but it's a kind of a new product that we've been doing a little bit of in the commercial world this year. And I guess, sure.
Could you repeat the question, please?
Yeah, the question was, what is the interest rate? It always is the question. What is the interest rate?
It's true.
The interest rate on that line of credit versus a regular mortgage may be higher. May not be, but it may be, probably will be. But in the commercial world, there's so many moving pieces that it's hard to give you a rate because every deal is its own thing. Like I said, that range rate that I gave you before, it's probably in there somewhere. So some banks are more willing than others to charge higher rates for risk. Univest is not one of those banks. Typically, if a deal is bankable, it's bankable. We have a tighter range of interest rates. Some banks have a broader one. But it's hard to give you a number other than the range. But if you got a particular property in mind and a particular deal, then we can talk and we can give you a better idea what that would be.
Sir, I'm sorry. I hate to interrupt you, but could you speak into the microphone so we can record this? This right behind you. Thank you. And you
So
have
it
to give
appears
us,
like we're at the Q&A portion of this
and
discussion.
you have, well, only if he gives us
And that's
his,
good. We're
only
right
if he
on
gives
time.
us his credit report before he asks his question. That's.
Do you consider individual net worth when you give the commercial loan? Let's say I have 2 or 3 commercial loans already, and I'm going for another commercial loan. Do you consider individual's net worth in your calculations?
Well, as in everything we discussed tonight, every situation is different, but the short answer is yes. We're going to look at your net worth. We're going to look at your portfolio. I mean, it all depends on how things are structured. I've got an LLC that is a holding company, and I've got 4 LLCs underneath that. Plus, I've got 2 LLCs over here that I'm partnered up with Mark over here on, and he's in those LLCs as a 50% member. So all of those things we need to know about, we'll look at and evaluate. You know, some things are more important than others, but they're all weighed.
Okay, good. Thank you.
You guys ready for Q&A, or did you have more
Absolutely.
content?
Absolutely. Bring it on.
Okay, so bring it on.
Thank you.
Hi. Is there a 6-month waiting period for the cash out refi?
Otherwise known as stabilized property or seasoned property. They're slightly different in meaning, but there is a time period.
Are you talking about commercial or residential, or?
I'm answering
single
only in
family.
commercial, by the way. When I talk, it's commercial. I don't know what these guys do.
Actually, there's a 6-month waiting period for residential. Now, based on Fannie Mae's changes, one big change I think that kind of affected investors in an adverse situation is that in the past, Fannie Mae considered if you held a property in an LLC, for example, and you're either a partner or you're the majority owner of that LLC, they used to actually count that as seasoning. The agencies, because there's a give and take, right? So the agencies loosened up on guidelines as far as debt to income. They'll go to 50% in some cases. They loosened up on the reserve standards and also how many finance properties you can have. They'll go to 10. The problem is there's a give and take, right? So because they loosened the credit standards, they actually tightened the seasoning requirements. What that means is they look at how long you held the title in your individual name. So for example, say you're an LLC, and now you want to change, because we see this problem all the time. You want to change the LLC to an individual name. Now to do a cash out refi, now you have to wait 6 months to refinance that. Now to counterattack the conservatism, what Fannie Mae did is instead of taking that seasoning requirement from the application date, they'll look at it to the closing date of the new note. So for example, you changed your LLC 4 months ago. Well, now, instead of waiting 6 months to make an application, what you could do is you can make an application, a valid application, and usually, the closing process could take 30 to 60 days. Now, you can wait that out, so that the time period where we're making a decision, underwriting decision, processing the loan, they actually give you that seasoning. So now, as long as you close 6 months at the note date, you have that seasoning requirement met, that you would qualify for that cash out refi. Now, we do have some special consideration refis. I'm not sure if everybody's aware or not. Fannie Mae will do, and Freddie Mac for that matter, if you bought a property in cash, or if you borrowed a fund, the funds like Doug was saying, from a line of credit, and you don't have the 6 month seasoning, Fannie Mae will do like an exception called delayed financing. It's kind of a hybrid between a rate term refinance and cash out. Like we'll price it and underwrite it as cash out, but we'll give you the benefit of a rate term, meaning you can recuperate all the funds that you used to buy that property, without counting as cash out, right? Now, the caveat to that is you would have to close less than 6 months, and you have to show how you bought the property. We'll get a HUD-1, a CD, what have you. But the biggest, I guess, challenge is, like Chris mentioned it too, any funds that were borrowed, or I should say, have to be paid back, to that entity on the sheet. So you can't get cash out for that amount and then pay it off afterwards. Or if there were any gifted funds. So that's one thing to be careful with on the residential side. If there's any gifted funds, So those funds would be ineligible to be recuperated. So for example, you buy a property for 100,000 and you put in 50,000 of your own cash, but the other 50,000 you get a gift from a family member. They will only allow you to recuperate the 50,000, right? But the good thing about it is you still recuperate something. You get a tax benefit of the write-off, right, for the mortgage, and obviously you get more equity instead of tying that money up in that real estate.
Okay. Thanks.
Sure.
And just to follow up on that, you notice how on the residential side, Fannie and Freddie, and there's a lot more regulations. On the commercial side, we have those, but nowhere near as detailed. So there are situations where on the commercial side, we may do a cash out refi on a property that's only had renters for 3 months, not 6. So we have flexibility that on the residential side, they don't have.
I never do anything normal, so we'll start with that.
Hi, Larry.
What's up, Dave? So here's the story. So I buy everything in, every time I buy a property, I put it in an individual trust with my LLC as the beneficiary. So as soon as I do this, every banker goes, I don't know. So the first question I have is actually, and the reason I stood up was because it piggybacked off of your answer before. You had said that if you have to move a primary residence from an LLC to a individual, then you can lend on it, but you need to wait 6 months. Is it the same with a trust?
Well, and it would be, obviously not just primary residence. So it would be any residential residence, right? So it would be primary, second home, multifamily, mixed use. We will do that as well. So we require that 6-month seasoning. Now with a trust, a little bit from a legal perspective, it gets a little bit more tricky, right? So from a trust, we will only, now we will lend, and you can hold a title as a trust, but unfortunately, like in your case, and this is why you're getting the adverse actions from the banks. On the residential side, a trust has to be a revocable trust.
Oh, they are.
Right.
Yeah,
But here's the thing, but at least one trustee and the beneficiaries have to be at least one of the borrowers, right? So it can't be.
You mean a personal guarantee?
Correct.
Okay, so
Well, no, not even guaranteed. So, for example, now you can actually move that vesting away from the trust, right? But again, it's not going to forgive that seasoning requirement.
Okay, so if I move, for example, I want to get a HELOC on my primary residence. We talked about it a little earlier.
Correct.
So I can't do this in 30 days. I've got to transfer the title. Then 6 months later, I can apply, or approximately 5 months later, I can apply, as long as it's 6 months.
Right, or sooner. And obviously, and again, I'm, disclaimer here, obviously not a CPA or an attorney, but obviously the problem is that you have to be careful, because when you're moving, you're vesting from an LLC to an individual or vice versa, as a lot of you may or may not know, there will be transfer taxes involved.
In an LLC, that's correct. In a trust, it's not.
Not in a trust.
As long as the beneficial
trust, that's
interest
correct.
stays the same, there's no transfer tax.
Correct.
And again, I'm not an accountant or attorney either, but I happen to know that.
Now to counteract, now depending on what you're looking to do, now if there's a valid lien on that property, no matter how it's held, as long as you hold title prior to closing, we could do a rate term refi, right? So it's the 6-month rule, I just want to kind of clarify, that is for cash out. So if you have a valid lien, for example, right, and you want to pay that off, and you're moving from a trust or even from an LLC to an individual, there really is no time period as long as you move that prior to closing. So we do have, and we have some flexibility on the portfolio side of that as well. 'Cause we will do some hybrid type products where we can, in some cases, depending again, like even Dave said on the commercial side, depending on your qualifications, debt to income ratio, cash flow, credit score.
Income? Sorry, income, what's that?
I guess we look at income.
I'm a real estate investor.
Sure, why not?
That's my other problem, but I don't even want to go there.
Or throw income. So yeah, I mean, so we have a little bit more flexibility because we've done some hybrid type products, right? Like on a portfolio side, if I can show, say you're 100% owner of an LLC or even of a trust, and you're moving it to an individual side, we have a little bit more flexibility on that portfolio side to waive that 6-month, seasoning, depending on the equity, depending how much assets you have, reserves. Obviously, the downside to that is on the portfolio side, as Chris mentioned, to offset our risk and our profit margins down the road, we only offer ARM products. But what's more attractive on our side is a 7/1 or 10/1 ARM. And typically, in today's market, the average life of a fixed rate loan is 7 years or 10 years. So as an investor, and I know a lot of people kind of get turned away from ARMs. I mean, our ARM rates are pretty low. I mean, and you kind of get the guarantee of 7 or 10 years, especially if you're an investor. At that point, whether you're moving that property or what have you, that could become a little attractive. So obviously, if you can, do some business with, and get a consultant on your side, we do have some pretty good options. So like on your case, on a portfolio side, we may have some latitude. Obviously, on the agency side, on a cash out, we don't have latitude, but then no one else would.
So, and the very first thing you said, and we kind of got distracted, but you said that if I owned a trust and I was a trustee, I can borrow or I can't borrow?
You can, yes.
Okay, so is it a commercial loan or is it a residential?
No,
loan?
it would be residential. So investing look, if you hold investing in a trust and it's a revocable trust, and at least one of the borrowers is a trustee or a beneficiary, we will do it on the residential side.
Okay, so I don't need, so then you're saying I really don't need to transfer it out.
Right,
I just need to apply it in the trust.
Exactly.
And you guys do this?
What we'll do is say you would apply individually for the borrower qualification, you would apply it as individual. However, you can hold that property in the trust as long as it meets certain guidelines, the legality of it, as well as long as it's revocable and you are named as one of the trustees as well as the borrower.
Right.
We would accommodate that.
Okay, and this is, I'm sorry, I lost my place there for a second. I'm sorry. Something I was going to say to that, but so got distracted. But it's fine. Okay, so I'll talk to these guys afterwards.
Yeah,
oh, I know what it was. It was cash out, so I could do cash out in the trust as a trustee.
You can, right. Again, it's going to come down to the 6-month seasoning. And as long as that trust is revocable, right, it doesn't have, and I mean, there's certain guidelines that the agencies look at. On a portfolio side, we can, we have a little bit more latitude on what we accept.
Okay, yeah, because I'd rather not transfer it out.
Right.
I'd rather leave it in.
Yeah,
but,
if you don't have to, exactly.
I mean, frankly, I would transfer it out and then transfer it back in 6 months later anyway.
Right.
But it's just a pain in the ass.
Right, exactly.
All right, cool. All right, I'll talk to you guys afterwards. Thank you.
Oh, you got it.
Barb, you have to take as much time as Larry did. Otherwise, no, go ahead.
So if I bought a 2-unit property that had the ability to convert a garage/barn into a 3rd unit, and I wanted to do that work and then refinance later, do I run into problems with the appraisal in getting a refi, a cash out refi, when it's all said and done?
That's a good question. I mean, typically, contrary to belief, and again, you might get different answers from different lenders, underwriters, what have you. Now we look at things from the agency side, but we also look at common sense, right? We're not checklist, type lenders. So the question, or the answer to that question is, look, as long as an appraisal is done, and this is the bottom line, a lot of people kind of forget, and this includes, we do a lot of construction loans, and we do a lot of builds on your own, property or your own land, where we do renovations. We strictly, if it's a refi transaction and you've been on title, we will strictly go by the appraised value. So there is no 12-month rule like back in the past where if you bought a property in the last 12 months, we're going to use the lower of the appraised value or the purchase price. We deviate away from that because the agencies, look, as long as the appraisal, and remember on the residential side, commercial might be a little bit different. On the residential side, we rely solely on the resales values of other properties. So we look at the sales approach. So we don't deviate from that. We don't look at the income approach. We don't look at the cost approach because it really has no bearing in the residential market, right? So for us, we look at the collateral risk is, hey, look, if I'm going to get that property through foreclosure, can I sell it for more than I have encumbered on it? So the bottom line is, as long as it appraises, we're going to look at the appraised value. So you can dump that money, and we're not going to ask for, you guys can remember this in the past, those who have done these, and a while ago and prior to the crash or what have you, we're not going to ask for receipts. You've had your people in the past or learners in the past say, okay, that's great, appraised value is $200,000, you bought it for $100,000. However, we want to look to see what kind of improvements you've made. Well, typically that's the appraiser's job, and we don't deviate from that. Because obviously, from a legality standpoint, we're not appraisers. We're not out there to evaluate properties. And I know my team, we look at it from a common sense standpoint. So if you justify the decision, we're pretty much going to go off of that. It's an opinion. As long as it's supported, we pretty much will lend on that value.
Part of my concern in this particular situation is that there aren't many 3-unit sales in my town, in the town of this property.
Right. And again, where it's going to come down to, and this is the unfortunate thing, I don't know if there's anybody who's been an appraiser in the room or not, but appraisers are dwindling, right? So, and with that said,
You mean people in the field?
well, people in the field, yeah, right, in the field. So you're right. So it's going to come down to the appraiser, right? 'Cause if an appraiser can compound that property, great. And that's a challenge, right? That's a big challenge. Now I know from some of the appraisers that we deal with, we have certain markets, that they're aware where we land. We do a lot of multi-units, and look, and the agencies came out and they kind of stretched the limits on appraisals, right? But remember back in the days, you had to be 10% adjustments. They looked at, are you 2 blocks away from the property? So the agencies kind of, they've realized that. So they kind of expanded on what kind of comps you can use. So you're not always constricted now. So if you're in a small town, for example, or if you're in a municipality that might not have a lot of, 3-unit properties, if that appraiser could go to a neighboring township, right, and that has the same market conditions, same economic conditions, you can use that comp, right? And we do have appraisals. We have a kind of direct line with our management company that we deal with, where we can pick up the phone, and that's either the sales staff or myself or even my team, and we can gather some information and get a feel of, hey, where's this going to come in? Is this going to be a problem? So the agency's that's one good aspect of some of the regulatory changes and some being transparent, but they also expanded some things. So they realized, look, some of these markets, you might not get that type of property or uniqueness of that property, so you can expand the market. So if you have those challenges, it's going to come down to how it's mitigated with the appraiser, right, and the management company.
Okay, and finally, what's the LTV on a 1 to 4 family that you would lend?
Right, so it's going to depend, right? So if it's going to be a primary residence, right, we could go a little bit higher, obviously, with if it's going to be an investor unit. Typically, on the agency side, right, they'll do 85% on a 1-unit investment property. On a 2 to 4, they'll cap you at 75%. I think, and that's kind of like the Mendoza line we use for portfolio. However, again, on a portfolio side, if we have a strong customer, we might go higher. We might go to 80% in some cases, depending on the credit profile. I think the biggest difference, between Dave's side and my side. So on the commercial side, you get the short-term financing, right? You get a 5-year balloon, basically. That's 20-year amortization or 25 amortization. We look at the long-term financing, right? But we obviously risk-based price it. So if we can risk-based price it, right, and we have a strong customer, we might make some exceptions on that. So that's where we have a little bit of latitude on the portfolio side. And we will do, it's kind of unique because we will do mixed-use properties on the residential side, right? If you're applying as an individual, right? And if you have properties held in LLCs, and they're not tied up with personal or residential mortgages, we don't even look at that. From a cash flow perspective, we'll treat that piece as self-employed. If you have positive cash flow, even negative cash flow on your tax returns, we'll look at the depreciation, some add backs, and call it a day, and not hit you with that debt. I know, because I know a lot that's where a lot of things kind of come a little gray. But again, on a portfolio side, we have a little bit more flexibility, and that's where it can help on those multi-units, maybe going higher than 75%, maybe 80%, depending on your credit score, your debt-to-income ratios. Obviously, if you can support a lower debt-to-income ratio, say under 43%, and you have some reserves, and especially if there's a relationship sometimes, if we have a bank relationship, we'll consider those.
Thank you very much.
Oh, you're welcome.
Thanks, Barb.
I have a question directed to the commercial loan. What you described as the requirements pretty much fit my experience. One thing you didn't talk about is prepayment penalties, and traditionally aren't they 5, 4, 3, 2, 1? And is that still the way it would work? And could you speak on that, please?
Yeah, most commercial loans that you're going to see out there have a prepayment penalty to them, and it's a declining one. Our particular bank has a standard 5, 4, 3, 2, 1 on their loans. But it's, looking at other banks as well, that seems to be fairly standard across the industry.
Okay.
Yeah.
Thank you.
What bank regulation changes are expected in the next 6 to 12 months for borrowing or lending, as the case may be?
Of course, Chris gives it to me. We don't really, now, obviously, from just to kind of make it clear on a regulatory side, right? I think it's kind of status quo. We don't see too many changes forthcoming. Now, I know one big change has been on the, and I'm not sure if everybody's kind of familiar with this or not, but the residential application, they're looking to kind of expand. So those of you who've kind of have done this in the past, obviously we have a 4-page application that's going to turn into like an 8 to 9-page application. So obviously they're going to look for a little bit more in-depth information. They're looking to streamline it or get more detailed information. I think sometimes it might be a little bit of an overkill. The good thing about it, it's been delayed, since to 2020. So from that side, I think we have some reprieve. I don't really foresee any significant regulations per se. What I can say is from a lending perspective, especially with the agencies, I think you're going to see probably a little bit more loosening of the guidelines as we already have seen. And I think a lot of times what happens is, Fannie Mae is kind of like the guinea pig because, Fannie Mae obviously, is a little bit larger than Freddie Mac. And I think they kind of come in a fourth front to make some changes and kind of Freddie Mac, kind of follows suit to see how Fannie Mae's changes have performed, so to speak. So that's kind of about it. We don't see any large changes. I think as values tend to hold steady, and actually we do see an increase in values in a lot of areas. I think you're going to see probably some loosening of credit standards. Not to the point where we saw prior to 08. But I think you're going to see some, loosening of standards and probably some products that might inhibit, higher debt-to-income ratios on the residential side and may infuse more, looser standards, especially on the renovation loans when it comes down to investors. That's what I see personally. There's really nothing out there that we see, or at least we don't have that much knowledge. But those are probably the main things that I have seen or have heard about.
Okay.
It's Chris Leonard. I don't have a question. I actually wanted to give a testimonial to Doug Schnell. I've known Doug for 12, 15 years. And he's not only been so creative, he's helped me sell a lot of back-end deals for me. So Doug knows his stuff, and I appreciate it.
This Doug Schnell? I just want to make sure.
Same guy.
Okay.
Thank you, Mr. Leonard.
Okay, so Mr. Leonard, then you can buy his dinner. How's that? Okay. Okay, any other live questions? If not, we'll go to this screen here. So, do you do self-storage projects, or I assume that means, or new construction? Who would like to handle that?
I think the commercial guy's the only one. And the answer to the question, actually, there's 2 questions there. A self-storage project, would we finance a self-storage purchase? If you could find one, absolutely. But they're not easy to find for sale. New construction, yes. If you have a construction loan on the commercial side, you get an LLC that wants to buy a piece of property and build something there, we can absolutely do some kind of financing there.
Yeah, I don't know who asked the question, but did you mean new construction of self-storage projects? Okay, does that same answer, David?
Yeah. I mean, again, every project is unique and so therefore needs to be looked at, but we would consider looking at that, yes.
Okay. Next question. Next question. How do home prices rise and appraise at a higher price when appraisals are based on prior sold comps? Good question.
Yeah, we need an appraiser up here.
Yeah.
Our experience has been, especially of late, because it basically, the market kind of outpaces, let's say appraisers are backward looking, right? The market is forward looking. So the challenge, and this speaks to a question I had earlier too, like the pressure's on the appraiser, right? It's less on us in this particular instance. But we have seen some of the appraisers making a time value adjustment, it's called, to take into consideration like a hot market or something like that, where, if you're looking at sales that occurred a few months back, well, that market has already accelerated and outstripped what sold, 2-3 months ago in some cases, especially, you get in certain areas of Philadelphia where the market's red hot. So, I don't know if that answers your question or not as far as the appraisals are concerned. I mean, we're not going to get into a situation where the appraisers are going to guess the market or try and forecast it. I mean, they have a difficult job. I'm not envious of them. It's difficult if you have a property, subject property. They're looking for 3 similar units that sold in the last 6 months within a 1-mile radius. You've seen the market out there. While we're happy with the pace of the market, there's still just so few transactions overall, right? So if you get into a situation where the property is unique, the subject property, that makes it even more taxing. And we've seen appraisals that maybe are using comps from a year ago or something like that. So, I don't have anything but a vague answer there, unfortunately, other than just alluding to the fact that they'll make a time value adjustment in some cases if it's warranted. But yeah, I mean, appraisers already touched on it. It's such a difficult role that they play. There's a lot of pressure on them. They segregate, as Adrian said, themselves from the lender. I mean, this is part of the Dodd-Frank regulations where they have to operate independently. Basically, there's a barrier there, like an appraisal management company, that will rotate these appraisers in on a round-robin basis, and they do not want, or they want to discourage, a lender from putting pressure on that appraiser to make a certain value, right? So, for example, back prior to the 2008 crash, what you would get is, hi, I'm Wells Fargo, and Mr. So-and-so, you did 250 appraisals for me this year. By the way, if you can't make the value on this property work, you're not going to get the 250 units we would allocate to you next year. So the appraisers were under a tremendous amount of pressure, and it was very unfounded, and it caused certain people to act, in ways they shouldn't have, right? So that kind of jeopardized things on that regard. But yeah, presently today, they're very segregated. What we see is when an appraisal comes in, the appraisal management company has already kind of troubleshot the value, troubleshot like the comparable sales and things like that, and then they turn it over to Adrian's group where they will further analyze it.
Yeah, I guess kind of to answer the question kind of direct, I mean, how do values really rise, if appraisers are looking at comps and their prior sales? It also kind of matters, what time period or season you're looking at, right? So in the summertime, right, the spring market, summer market, as we all know, that's when real estate, especially on the residential side, is hot, right? So you have more available comps. You have comps that sold maybe, a week ago, maybe a month ago. So depending, fortunately or unfortunately, if you're buying a house in the heat of the market, you might find, some additional comps. Thus, some appraisers, Chris said, they may make some time adjustments, but if you have an ample amount of comps out there and they support the value, and sometimes, in some cases, they could use cash sales that may, kind of help, values kind of stabilize or go up. I mean, that's kind of, I guess that's kind of the short answer. I mean, a lot of times in the heat of the market, when the market's hot in the summertime, you have more comps, right? And if people are buying, there's more ample comps for the appraisers, so the appraisers are using more recent comps, right? And that's going to support the value, so thus values will go higher, right? Even if you're looking at comps that were sold in the past, because obviously, we look at the past to forecast the future in this business. So it kind of depends on the season, right? So, you're going to be looking at purchase money mortgages in the winter time. There's going to be less ample comps. So what that means is you have to go further back, and you might have to make some other additional adjustments. But that's how physically it can happen. So because you have a lot of the activity in the summer months, you have more ample comps. Thus, that stabilizes the market. So if that kind of makes sense, that's how I foresee answering that question.
I don't want to get bogged down in the appraisal process, but if you're asking the guys to go back, let's say no more than 6 months, you're always looking at the previous season, right? So the summer appraisals are looking at the winter comps, and winter comps are looking at the summer. Winter appraisals are looking at the summer comps, which, or, how do you adjust for, two questions, how do you adjust for that? Second question is, if an appraiser comes in with a higher number because the market is going up and it doesn't quite get supported by the comps, do you ask for an adjustment? Do you look for another appraiser, or what do you do?
Right, that's a very good question. To start off with the second piece, kind of the second answer, if the value is not supported by the comps, we'll go back to the appraiser to provide additional information. One thing I can say, the appraisers that we deal with and the appraisal management company we deal with are pretty open. And I'm not saying they're going to, write whatever value we look for, but I know from our end, the way we mitigate it, a lot of people say, I don't believe to be conservative for the sake of conservatism, right? It doesn't help anybody. Because obviously you have a lot of the big banks out there, and they're kind of black and white when it comes to underwriting and values. Look, we're not appraisers, so we look at it from a professional opinion, and that's how I kind of mitigate it with my team. If it makes sense and the appraiser has justified his decision and his comps, we kind of look at it from that perspective. Now, one thing to add is, again, the agencies kind of loosened up some of the standards, right, because of the crash back in 2008. They realize, look, you might have some unique properties, right? So what do you do at that point? Do you deny the loan? Do you deny the customer for collateral? Well, no, you don't, right? So what do you do? So you could go and kind of broaden the horizons. So typically, we don't, in the summertime, you might have more comps, so you're not going back 6 months. So you're not going to go back 6 months. You might go back 1 month or 2 months. Now, in some cases, for example, like I kind of stated this earlier, if you're in a market and there are no viable comps, right? Because you really don't want to go 6 months out. You're right. That's a whole different season. We try to stay somewhere around 3 months, right? Because that's going to give you a more accurate figure of where the value should stand, or it's a little bit more indicative of the value. And we can expand, right? You can expand to a neighboring township, right? To a neighboring market. See, the agencies, contrary to belief, everybody kind of thinks that, look, lenders and unfortunately, I think it's a doing of most of the lenders. It's kind of self-inflicted. I know we kind of try to stand away from most lenders in this aspect. Is that, you have a lot of checklist type, reviews when it comes to appraisals. And I think that really damages the market, right? You kind of got to expand your horizons and your kind of thought process and philosophy. So we try to look at it from a perspective that, look, and the agencies came out with this, if you don't have the viable comps in a specific neighborhood or market, you expand to a similar market that has same economic and market conditions, because that's going to be a little bit more indicative of value, right? You're not gonna stay in that same market for the sake that it's a property that's sold 8 months ago or even a month ago, but you have to make so many adjustments because that property is not similar. Like you pointed out before, the three unit properties. You might have to expand your searches, and we will accept that from the appraisers. So we're not there. The days of underwriters looking at the appraisals and cutting value are pretty much gone, right? It pretty much makes it almost a regulatory issue, right? For a fair lending issue, because we're not appraisers. So we look at kind of like for face value, and if the appraisers, like I always say, like, tell me what the value is. Good, bad, or indifferent. Don't go conservative just for the sake of conservatism. So I think for that, and I know we have a very good relationship with our appraisal management company, so we can mitigate those type of situations. So again, recap. If we can't find something suitable in 3 months, that's a comparable. We can expand the market. We can also have the appraiser make appropriate adjustments on the positive side, because it's going to be warranted, and if it's warranted and it meets typical lending environment and requirements, we will accept that appraisal.
Thanks.
Value, I should say.
Marty?
So in line with that, I'm thinking of a situation where, because it's such a competitive market, you get multiple offers, you get into a bidding war, and the ultimate price is, say, $10,000 over market value. Can you use those additional bona fide offers in lieu of comps? Because people would have paid that price if they could have been the high bidder.
It's a very good question. I mean, unfortunately, like I said, from a residential or just a lending side of practices, we have to, for value to be established, it has to be a valid sale, right? Because especially on the residential side, we strictly look on the sales approach. So meaning on viable comparable sales. However, contrary again to a lot of misnomers and belief, say for example, that same situation occurs. So most appraisers have, kind of been taught or kind of and they got smart at this point to realize what the lenders want. Most appraisals on the residential side, you'll see 4 comparable sales, and they will also provide market data on active listings, right? Properties under contract, what have you. So they will apply some of the value on those active listings or properties that are under contract. However, they're not going to have as much weight or merit, because obviously on the residential side, we can only see the price that it's listed at, right? We don't know what price is on the contract. We don't know what price it was offered, right? Because it's not public record yet. So for us to have a viable comp, it has to be public record. We have to verify it. However, what you can do, if there's a situation where an appraisal may come in lower, like in your case, and you have 2 viable listings, right, or even under contract, what the appraiser can do, so say for example, say from the time that the property was appraised and prior to closing, that listing or that property under contract that was under offer sold, right? So now we could go back to the appraiser, because now you have a documented extenuating circumstance, and you have a documented reason why to go back and reevaluate that appraisal. So we can go back to the appraiser and say, look, comp number 6, that was a listing or it was under contract, is more indicative to our property, is sold since that appraisal. And here are the details. Here's the MLS listing. Here's the write-up. You can give that to the appraiser, right? Because through Dodd-Frank, through the other regulatory changes, and also through the interagency guidelines. I know in the past, everybody looked at the effective date of the appraisal. That, hey, once you looked at the effective date of the appraisal or inspection, you can supply additional active listings, but you can never get comps prior to that date. Well, the agencies, again, knowing the situation in the market, and they know there's unique situations like that, that might provide better or more indicative information. They now allow that you can use that comparable or 2 comparables after the initial inspection, after the initial effective date of the appraisal, and if it has an impact on value, that could be a certain situation or we could go back to the appraiser and the value now could be substantially higher. So that's how we would mitigate on that side. Appraisers won't use the active listings or properties that are being offered under contract until they actually become sales. The good thing now is, like I stated, you can't go back to the appraiser. Once you confirm it's a valid sale, and we have a public record of it, which will help or may help impact the value.
A follow-up to Marty's question might be that the buyer who bid $10,000 over the previous buyer or the other buyer in the bidding war now has to get a mortgage. But there's no comp to support that extra $10,000 for all the reasons that you just said. So was that the question you were going to ask? Or Adrian, so how does the buyer now get a higher a mortgage for more money because he's willing to pay for it?
Yeah, that wasn't quite the scenario that that I had in my mind.
Okay.
The scenario I had in my mind was, let's say you have 3 or 4 offers on a given house.
Okay.
They're all above asking price.
Correct.
The seller ultimately takes the highest one, but now he's got 3 other bona fide offers on that house that were all above asking. Can he use those 3 other offers? They're never going to close because the house is being sold to the seller.
Right. He can't,
to the buyer.
No, he cannot, because again, it all comes down to, because remember, with the regulatory changes and the transparency, for us, for valuation purposes, the appraisers have to use valid closed comps, right? Because we look at the sales approach, right? And the only way we can verify, it has to be verifiable, right, through third-party means, meaning public records or the MLS trend, whatever the realtors use. So unfortunately, they would not be able to.
Billy's worried about the danger. It kind of goes back to kind of my opening statement. One thing we want to prevent from happening, and this is appraiser's job too, ultimately, is we don't want to contribute to an inflating market, right? So we don't want to put that prospective homeowner, whoever it is, in some kind of jeopardy where the property is never going to, it only supported itself through, let's say, a bidding war, right? But then, they can't tell you, say, 6 months from now, is the market going to, maintain that level? Is it going to sink or whatever? Like, that's why they want to try and substantiate it. We have had some success. Like, this is one area I'll tell you after, this is my 20th year in the industry. We've had a lot of ebbs and flows in the valuation area. I will say in the last, few years, I think they've made some tremendous strides. I think the appraisers have done a decent job at setting a value. We've had experiences where we've overturned values here at Univest where we've challenged the appraiser. We've come up with a dispute process. And the last I will tell you, not this is frequent, but let's say, the 5 that crossed my desk since January, 3 valuations were overturned, right? So we were able to effectively support that the property was worth more than, let's say, the initial appraiser assessed. We've had, and this is not ideal, but, where we knew that there was a potential listing that was like a linchpin to setting that property value exactly where all the parties wanted it. I mean, that's the irony, right? Like the buyers and sellers have agreed to this value, right? That's the, how can I get my head around this aspect? But that's why, again, we want to see those 3 comparables. That's what comparable means. It has to be similar in some way, shape, or fashion. But we intentionally delayed, in this one instance, a settlement. And again, not saying that's the ideal methodology to success here, but all parties were in agreement when we presented, hey, we've got this one comp that's really going to push us over the top. Are you willing to wait 30 days for that property to come in so we can count it as a valid, sale and support that it's been recorded? And at that point, all parties said, why wouldn't they? Typically, if the buyer wants the house, if the seller wants to sell it, all parties were level-headed and cool-headed enough to say, you know what, let's do that. Let's stagger the appraisal. Let's pick up that additional comp, and we wound up closing, albeit 30 days later. But it was to everybody's benefit that we did, right? So unfortunately, Marty, yeah, I mean, I wish I was an appraiser. We had one up here that could better answer that. But from a lending standpoint, we're going with those three best comps, and they are, put in sequential order. So we go with the best comp number one first, and then work our way down. As Adrian mentioned, it's funny when I look at appraisal reports these days. It used to be that the appraiser kind of did, I hate to say this, I'm not trying to pick on, but the absolute minimum, right? Like those three comps were the only three comps you ever saw, right? And sometimes those only three comps made or broke your deal. Nowadays, we see appraisers kind of voluntarily throwing on, 6 comps, 9. They know that there's a lot riding on that particular transaction. They're not going to cave to pressure, but they are going to do everything in their power professionally to try and make those numbers work however possible. So if it means that they need to add some extra pages to the report, they're going to do that, or they're going to try. So I hope that helps you. I know it's probably not the answer you're looking for, right?
I think we could do an entire evening just on this one issue. Do you have a quick follow-up, Marty, or you're finished for now?
Well, as simplistic as this sounds, I always thought that market value was whatever someone was willing to pay for something.
Sure.
And if someone's willing to pay $10,000 over asking, then I don't see why that's a problem.
Well, I guess it's the evidence of that, right? Like an offer does not a value make, right? Ultimately, the market has to bear that out, and basically, we've seen people make bids on properties that maybe, they weren't really good bids, or they weren't in other words, we don't want to get a situation where we're defaulting always to the highest number, because there's an inherent danger in that. We want to make sure that, in other words, like we can't have a property up here on a subject and then the comps are all down here, right? Like, so that even the $10,000 is kind of like one example of that. I know it's just an example, but we want to make sure that there's some parity, I guess, with it. It's one of those things where how do we evaluate somebody's offer, right? It's harder for us to do, so that's why they go to the public recording and substantiate it that way. Yeah, do you have more you want to add?
Well, no, I just kind of want to say, I mean, Marty, you're right to a point. Because look, there's a difference between a true market value and a market value that the lender's willing to lend on, right? That's what it comes down to. So you're right. I mean, a market value in that situation, if you're buying a property in cash, right, or you're going outside the lending environment, then that's true, right? And that's how values do hold up, and that's how values do increase. The difference is in a lending world, right, our environment, we have to look at, true viable sales. So we look at the property sold to forecast where the value is going to be. But in a way, you're correct. I mean, a market value is the value that somebody's willing to pay for it, right? And if that becomes a recorded sale, then you're correct. That is the market value for that property or a similar property. The issue is, where does a lender fit in, right? The lender's market value is different than the true market value.
So
that
then
makes sense.
The real answer to that prior question about how can prices rise
Correct.
if you're going to work off comps
Correct.
is that you've got to have some cash sales in there that don't depend on bank loans
Exactly.
in order to raise the comp prices.
True. In some cases, but in today's market, don't see too many cash sales, right? Or typically the cash sales on a, say, REO or investment property, what have you, will actually be the opposite, right? They will be lower than the market. And that's, not typically, or not, I should say, not always, but typically. So it's kind of, so that's why a lot of appraisers won't use cash sales, because they know a lot of times on a cash transaction, it's going to come in lower than the market, right? So it's you can't have your cake and eat it too kind of situation, unfortunately. But that's kind of where we stand, unfortunately.
Then I don't have any idea how prices ever go up if you're not going to use cash.
I don't want really an answer to this, but the opposite analog is the stock market.
True.
If you borrow money on margin to buy stock,
Correct.
the guy who's lending the margin money doesn't care. It's the stock market, which is just what you're willing to pay for the stock and what the guy's willing to sell the stock for. If you borrow money to make the purchase or short it, and you lose, you still lose. There's no issue about whether it's the right price or not. So don't answer, please. It'll take too much time. I just want to call everybody's attention. We're at about almost 8:40. We have about 15 more questions. I don't think we can get that done in a few minutes. So just by show of hands, how many people want to continue to say 9 o'clock and then we'll end, or how many people want to end now and we'll ask our panel to take the remaining questions, I'll send them to you and ask you to respond if you can, and I'll send them out by email to everybody. So show of hands, how many people want to end the formal discussion now? How many people want to continue? How many people don't care? Okay, I think the ending it now wins. So are there any must-have answers, burning questions right now before we end? Okay, well, let's give our panel a great round of applause. Thanks, guys.